Hey everybody, welcome to Trading Capital's Daily Analysis video. I'm your head market analyst here on July 25th, jumping into the charts on this Monday, start of the new week. This week it's going to be action-packed. We have a tremendous amount of earnings that start really today, but mainly carry into tomorrow and the latter half of the week. Specifically, the important ones like mega caps are going to be reporting mid to late in the end of the week. And then, of course, we also have the FOMC meeting that is just wedged in between there and a variety of other economic data that should be released. So what has transpired? And first off, I just want to say it's good to be back in front of all the charts again. I did have a fantastic vacation away, and that being said, we were still able to print and generate exceptional amounts of profits. Yet again, one of the most profitable weeks that we have had here at Trading Capital. So congratulations if you banked profits with us. But let's just jump right into the S&P 500. So interesting price action today. The S&P did finish just slightly positive, up 0.12%, as opposed to the NASDAQ was down 0.5%. So there was kind of a whipsaw, choppy price action all day. The markets really had no direction. And I think this is the reason why we're seeing this, is because obviously there's a lot of uncertainties this week with earnings and then the FOMC meeting. Is the FOMC going to raise rates by 1% or 0.75%? The markets have priced in 0.75%, but even if they do sneak in that full 1%, being the fact that there's no August meeting, the markets shouldn't have. You may see a little bit of a panic reaction to the downside, maybe a couple percent down on the spiders, but I do think the markets have overall priced in either scenario. That being said, earnings are going to be the big card that drives this market either higher or lower. And we're in the camp that this market sees more downside. But analyzing the S&P 500 today, this is the intraday 10-minute chart. So this is your pre-market trading. You had a massive gap up, and the gap actually failed even before the markets opened. So you had a beautiful gap up pre-market, and then during that pre-market trading, you came back and you filled that gap. And then you tried making a little bit of a rally, failed, made a new low, and then ultimately you were just chopping all day until you started breaking down again. You did hit this key support trend line, which you're connecting a pivot to another pivot to another pivot to another pivot. Now, the interesting thing that we have to do, if we flip to the hourly chart, you do have this head and shoulders topping formation. Now, it has not triggered. I will repeat, it has not triggered. So it doesn't mean there is a probable move to the downside. It's just something we have to be aware of. So flipping back to the 10-minute chart, if this was to confirm below the neckline on an hourly close, then it would open up the probabilities to a move down to this 386.40, 387 level. That would be the completed measured move of the head and shoulders formation. As well as if you do start to break that, I do think you eventually come down here to this gap fill down over here around this 382 and change. But overall, if we flip to the daily chart, let me just erase a couple of these lines for now. If we flip to the daily chart on the S&P, just focusing on, let me just quickly hide that. Just focusing on this recent price action here. Here was our low that we made, pretty definitive low. You've had an initial rally, a little bit of a consolidation, a little bit of another rally, failed to take out this high, so you pulled back, made a new low, and then you rallied up and you've made a new high. But the interesting thing about this price action is now you're into resistance. You have this trend line over here, which connects a major pivot in May to this choppy consolidation over here, and now you just hit that pivot on your Friday intraday action. And the question is, it's a big question, are we going to see this bullish consolidation hold above this neckline of your intraday head and shoulders? If we do, then it does suggest that this market can move a little bit higher to potentially, and I say this is a big potential, but to potentially attack this gap fill around the 416. Now that's going to take an absurd amount of positive news, strong earnings, potentially a dovish Fed. So it's a big if, but we like to know the upside, we like to know the downside. On the downside move, obviously that intraday head and shoulders will watch, but if you break that, I do think a move down to the gap fill around 378 is very, very likely once we start to break this bullish consolidation. And notice, I'm just going to walk you through. This chart looks a little bit messy right now, but let's just walk you through starting from this COVID crazy run up. So this is your COVID low where the money printing started. And this was a beautiful trend line that we're watching from your COVID stimulus. You were managed to keep above this trend line for over a year based off of massive QE and low artificial interest rates. And then you broke that trend line. And that was the key signal that this market was going. But since what I really want to bring to your attention now is we've had this multiple series of similar pattern breakdowns. So over here you can draw a trend line across from a pivot to a pivot, and this is where you broke down, had your nasty sell-off. So this kind of triggered your topping formation. And then once you had your bounce, you retraced to this area, this original breakdown zone. It was massive resistance, so you fell again. And then you retraced again to this resistance zone, this original breakdown zone, and you started selling off because you could not close above that. So again, leads us to our next area of support and resistance. So this is your new, basically, I don't want to call it a neckline, but this is your new support level where you have a pivot, and your pivot over here. And this now has become resistance because you failed to close above it. You broke down, confirmed, retraced not once but twice to this area of resistance, and then sold off again, which leads us to now our next level of resistance and support. Over here, you had support over here, pivot, massive bullish consolidation chop before this chop ended up breaking down to the downside. So overall, the importance of these pink lines going back here is to represent that you often get a retrace back to this resistance line, and then the breakdown resumes. So over here again, you had your breakdown. This is your new resistance, your pivot to your pivot tops over here, and look what you just hit on Friday, another pivot. So the question is, if we can recapture and close above this trend line, there's likely more bullish price action. The longer we stay below this trend line, then it favors a breakdown. Just like we had here, markets were looking very, very promising, had bullish consolidation, and then I believe this was the surprise Credit Suisse rate hike, and so the Bank of Switzerland rate hike, and it really, really spooked the markets. So honestly, there's a lot to consider with what's going on, but we are into major daily resistance on the S&P 500. If we flip to the intraday action, obviously some earnings must have come out. It is taking a little bit of a dump in the post hours, considering we had this late day surge, 1, 2, 3, 4 day, 4 10-minute candles in a row. Now we've had a nasty down candle over here. So that's probably on the back of the companies reporting more negative earnings. If we flip to the Qs intraday action, this is the trend line that I've been watching, pivot to pivot to pivot. You got your retrace over here, and now it's looking like you're going to continue to trend lower. You've broken a key uptrend that you were keeping for multiple days, and now you've broken it. So the key question is, and why I'm a little bit more bearish on big cap tech and the QQQ, is for this one simple candle formation. So you had this beautiful 3-bar surge to a high, closed at the high on the day. The next day you rallied up a little bit, made a new intraday high, but reversed and engulfed this candle. You engulfed it because you made a new high and you made a new closing low. So that's a bearish engulfing candle at a very, very strong resistance level. And ultimately, again, you can see that you ran into your pivots over here, pivot low to pivot to your gap breakdown zone, another pivot zone over here, and you've failed to close above this candle on a confirmation basis. And not only have you on a daily basis have you broken that strong uptrend, by now tomorrow sets up confirmation day in terms of whether the Nasdaq gets another down day. If the Nasdaq gets another down day, you ultimately want to see, if you're a bull, you want to see this level, this 296, this pivot, major pivot zone here hold. If you break and confirm below that, then it looks like big cap tech's going to have a lot more downside ahead. And we ultimately do think there's going to be a lot of downside ahead, but eventually you should get some sort of a more robust bounce. I don't believe it's at this level. I do think the longer term picture, we still have to go a lot lower. If we flip to, like, say, the weekly chart, you can see there's a couple channels I've been watching, but this is an April 2000 high to a 2002 low. You just hit a high here. I'm not saying we're going all the way down to this channel. There is another channel I'm watching from 2008 to your pivot here in 2015, going through your COVID low, your 28.2 market temper tantrum. I think this is going to be a big level around this pre-COVID high over here, which should correlate more with this low range or this upper range of this channel over here, this multi-year channel starting from 2007, connecting multiple pivots. So I think somewhere maybe in late Q4, we could see the NASDAQ definitely touching these pre-COVID highs. And obviously, if the markets catch some fear and negative earnings, things can be sped up a lot faster. Let's take a look at WTI oil. Oil has had a positive day if we just take a look at the daily chart on oil. So oil, not much new price action to report. It is positive, so therefore it did give the energy sector a big boost, like the XLE and a variety of other names that we have shorted. In the event that oil goes higher, we'll look to add to our SCO short. I do believe we have added to our SCO short right about here, so it's a pretty fresh new position. But if we do get a secondary retrace back to this channel, we will look to add. You obviously have this resistance over here, which would be another add level, and then we'll have to reconsider from that point on. Overall, let's take a look at natural gas. Natural gas is very fascinating price action. We are starting to accumulate a short position on natural gas. We did add to our KOLD today. One of the reasons why natural gas is so intriguing to me is you've now come into massive resistance. So this is your wide range red bar. Arguably, this is the nasty sell-off that started natural gas's down leg. And it's going to take some time before natural gas gets through this red bar high over here. I don't think you're going to get through on a straight shot. I think since you've had a pretty impressive move from this 530 level all the way to this 870 level, that's very, very strong move to the upside. Not only are you into massive, massive resistance, but you've also completed a near picture perfect measured move. When you take this low to this high, it's basically the same distance and same measured move from this low to this high. So you're now into massive resistance, a wide range red bar. You've completed a measured move. Not only have you completed a measured move from this low to this high, but when you look at it on a shorter term price action basis, this low over here to this high over here is the same distance as this low over here to roughly about this 854 level over here. So you have two symmetrical moves, and how I did that is basically this is your original breakout, your bull flag, your retrace, which is your bottom candle, and then you shot up to your high, and then your next retrace zone, which is your bottom candle over here, and you shot up to this high. So you've completed two micro measured moves, you completed one major measured move, and you're into massive, massive resistance. And I do believe natural gas should start to fall in the event that it goes a little bit higher. You know, we have a lot of maneuverability considering it's only a 3% position in our portfolio, and I'm willing to take this up to about 7 or 8% at that if the right setup occurs. But ultimately, we shall see if the technicals prevail with natural gas. Let's take a look at gold. Gold is very interesting too. Gold I haven't touched base on in a while. Obviously, it's been a week of price action, but you can see that gold has formed this parallel channel. You are at support. You can see that you were hammering on the support line multiple times. You actually pierced it, and then had this beautiful reversal candle off of the low. So it just shows you that the 1681 area is massive, massive support. It also coincides with this pivot over here. It'll be interesting to see if gold can hold this level. Obviously, it's going to coincide with multiple factors, like if the dollar continues to surge, gold should sell off. But if gold can hold this level, I do believe it can make a definitive move, at least back up to this 1800 level, where we'll start to head into major, major resistance. But the interesting price action on gold is if I zoom in, just on this little bit of a price action period here, this green candle over here to this high over here, this is all considered bullish consolidation. If we chop for a few days inside this low to this high of this green candle, that is extremely bullish consolidation, and it will favor a move up for gold. We really want to see, in terms, because we are long gold and a couple other mining plays, we do want to see gold really start to move higher after a few days of consolidation. Maybe even a week of consolidation would be healthy for gold, and then it would prove a decent base in order for us to challenge this 1800 level. Silver has also been hit very hard. It's moving pretty much in tandem with gold. If we look at the daily chart on silver, let me just let it load. You've had a nasty sell-off. Again, pretty much a near perfect measured move from this high to this low, from this high to this low is very symmetrical in the amount that it's declined. And you're also at the bottom of this parallel channel, which is acting as support. Notice you have a tremendous amount of pivots over here. You have filled a key technical gap on the SLV chart, I believe it was. So a tremendous amount of technical factors in and around this area. Obviously, with the recessionary concerns, that's one of the major reasons and components as to why silver has been selling off. With big cap tech being hit, obviously they use a lot of silver. Let's take a look at the mining company like Newmont, NEM. Newmont, the reason I'm bringing this chart up and touching base on the specific miners, not only are we positioned now in this trade, but if you look at the sell-off that this has happened, so ignore all this. This is when I shorted it up at the highs. But you're now coming into massive support. You have this multi-year channel going all the way back to 2016, connecting pivots in 2018, 2019, and 2020. And the clear thing is you're on this beautiful daily time count. A massive, almost looks like a capitulation low. And why I'm saying that is because you've had this massive influx in volume. I mean, you haven't seen a larger volume candle than that since you had this dump in April of 2019. So it's tremendous to note that you're on a time count. You've had a massive volume capitulation candle. You did have a gap down, which also strengthens the fact that you're near a short-term low. And you're also on a weekly time count. Look at this nasty sell-off. And you've completely measured and completed the fully measured move of this bear flag. So look at this. 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks of continuous downside. And this is a beautiful technical gap that you filled today, which is one of the reasons why we added to our position on a weekly basis. So I do think at the minimum, once gold catches that bid, and I do believe miners can move ahead of gold, and they typically lead gold higher. So if we start to see miners start to rally from these lows, then it does stand to suggest that the metal itself will move. But ultimately, at the very minimum, once Newmont catches a bid, I think we get a retrace back to this 52. One of the reasons I think this is so important is because it connects your pivot high here in March, pivot, another pivot, and it was your breakdown zone just before that key technical gap. So I do think gaps are meant to be filled. They certainly are more highly probable to be filled. So I do think a retrace back to that gap is extremely healthy. But you don't typically see a company like Newmont down 13% in one day. And I do think that is providing a tremendous opportunity for us to dollar cost average into a swing trade, considering, since the start of April, and we were long Newmont, and we've shorted Newmont. So, we sold our we started shorting Newmont at 83.94. Did I think it was going to go this low? No, I would have held my short longer. But ultimately, we made a profit on the short side, and now we're looking to make a profit on the long side again. But when you have a 48% decline in the matter of a few weeks, that is very impressive, and it does provide an opportunity for us swing traders to capitalize. Let's take a look at, let me just scroll through the radar here. So yeah, we did have majorly big cap tech was down, likes of Apple, Microsoft, Amazon, Google, Tesla were all down on the day. Let me just bring up Tesla since it is one of the favorites out there. So Tesla has some interesting price action. We're just going to go to the 1 hour chart. We are shorting Tesla. Our average here is at 809. But ultimately, Tesla has kind of, I wouldn't call it a head and shoulders formation like the S&P 500, because, some would argue that it is a head and shoulder with this left shoulder here, a head and a right shoulder. I just don't like this left shoulder. It's very flat, doesn't have a rounding top, and it's not as symmetrical compared to this one. But there is a case that you can argue that it is. If it is a head and shoulders trigger, you have triggered this head and shoulders by piercing the neckline. And the downside moves takes you about to the 785 level, which just so happens to be these pivot tops over here. So let me just flip to the hourly chart, erase that. So it would take you a downside move of that head and shoulders if you classify it as a head and shoulders. Should take you down to this 785 level, which is your next level of support. Ultimately, I do think Tesla is kind of going to perform. If we flip to the daily chart, Tesla has broken out of the short-term range that it was trading in, and now it's kind of arguably forming a new range, which is this orange trend line going up here and this orange trend line of support going over here. I do think Tesla is going to perform very similar to its previous earnings, where it has that sharp move up and then it just gives those gains back. So again, Tesla had that sharp move up, and I think it's preparing to give all of those gains back and head a lot lower. For us to start accumulating a short position above $800 here, if it does move higher, we have additional add levels. Our next add level will be around this 864, and then if it does get up to this 950-ish area, that'll be a big opportunity to short Tesla at that technical gap fill. Ultimately, it's going to be interesting to see how these companies perform in earnings. Certainly, we're going to see the market move. The volume in the markets have been extremely light. I mean, on the spiders today, on the daily chart, you're looking at 51 million with some post-hour action. So extremely light. I'm in the camp that we see the markets actually start to break down further. I do think that the Fed, is that likely scenario. We see that 1% hike. And I'm going to put my neck on the line and say we're going to get that 1% hike with the Fed or FOMC meeting. I think they're going to kind of follow what the Bank of Canada did, in the sense that the Bank of Canada was only supposed to set to raise by 0.75, and they also did a full percentage hike. And I do think it gives them the opportunity to let the market settle over a full month, where they don't have to really provide much guidance, and they'll just let the markets kind of sort themselves out, as the FOMC meeting typically, sends the market in a new direction. And the last three meetings, we've actually seen the markets falling into the FOMC meeting, and then they bounce and rally once the FOMC has its words and sends out its minutes and Jay Powell speaks. This meeting, we are actually rallying into the meeting. We've had an exceptional move from the lows, and I do think the Fed is going to jawbone this market back down, considering that inflation is still very high, and we haven't seen, with the latest CPI number, abate yet. So let's just consider all possibilities. I do think we're positioned well, more so on the net short side, to continue to capitalize on this falling market. I do think this market falls lower. There's a lot of people that are still denying the fact that we're in a recession because we have a strong labor market. One of the things that I try to make people understand is, despite the Fed hasn't started really aggressively moving on QT by reducing the money supply, what they have done is, obviously we know interest rates have shot up. They've had the steepest move in the shortest period of time in history, and on a percentage basis. So they're certainly raising rates. But what they are not doing anymore is pumping QE into the markets. So despite QT, which is actually withdrawing the money, the Fed has been expanding the money supply for a long time. And the fact that they're not providing quantitative easing to the markets is something that the markets have to get used to in and itself. So let's just say once they do start QT on a more aggressive approach, that's going to be yet again another factor. But stopping QE is kind of a form of tightening in itself, because our markets have been so used to this, steroidal free money that shot stocks up through the roof, created these moon boy traders that think things only go up. But overall, QE stopping is certainly a headwind for the market, not a tailwind. Interest rates are certainly a headwind for the markets. Declining GDP is certainly a headwind for the markets. Increased energy costs is certainly a headwind for the markets. Inflation at record highs is certainly a headwind for the markets. When you factor in all of these headwinds, it's very difficult to find a bullish thesis as to why markets should go higher. And it's just kind of a logical thing. If you stack up more pros versus cons, the probabilities are going to be more favored for the pros. But obviously, since we have more cons in this market environment, the probabilities dictate more downside, the likely downside ahead. That's it for today. Hope all this analysis helps. We'll continue to try to bank profits, and we'll just have to monitor interest rates carefully, the US dollar, gold, S&P, and the NASDAQ. But let's see what tomorrow has in store for us. It's always interesting waking up to earnings when companies either pop or drop. As swing traders, we really don't care. Obviously, we care about the positions we're in. But that being said, if a company pops, we short it. If a company drops too much into a technical level, we will buy it. And earnings is where we, as traders, nimble traders, thrive with volatility. So take care, everybody. Please give